Hey guys, welcome to the VIP Financial Education YouTube channel. I'm your host, Michael Matthey. Today we're going to be doing a video on the $1 trillion plus increase in consumer debt, focusing specifically on recent numbers that have been released from 2021. And then what we're going to do is talk about the correlation between that massive amount of debt and the massive amounts of inflation that we're seeing right now. Now, depending on a combination of inflation levels and interest rates, debt can actually be in some cases better for the borrower. In some cases, it can ultimately, obviously, be better for the lender as well. We're going to discuss both of those at the end of the video today, so stay tuned. According to the Federal Reserve, consumer debt stood at $15.6 trillion in 2021, which is an increase quarterly of $333 billion and just over $1 trillion increase from the previous year. Now, this is the largest quarterly rise since 2007 and the biggest annual gain ever in records dating all the way back to 2003. Now, the higher borrowing was fueled in part by rising prices as consumers coped and have coped with the strongest inflation seen in nearly 4 decades, which we're going to dive into inflation in the second part of this video. First, what we really want to do is kind of start by breaking this debt down so we can see what it really consists of. Now, the largest chunk is going to be from mortgage debt, which was up $890 billion over the previous year to reach nearly $11 trillion. Yes, that's 12 zeros, guys. While mortgage originations in 2021 had a new record of $4.5 trillion. Mortgages not only grew faster than after-tax income, but also faster than real estate values. This data for 2021 mortgages were also the first line of home equity cash outs since the third quarter of 2007. It's important to know that. I think it's probably safe to assume that many households may have wanted to take advantage of low interest rates while they still lasted. By design, we're hearing that interest rates obviously are going to be going up soon. People wanted to get in before that. Home equity cash outs also could end again soon once the Federal Reserve slows down its purchases of mortgage-backed securities, which undoubtedly is going to be happening in 2022. Next up is going to be student loan debt. That was up about $20 billion year over year. Forbearance programs most likely played a role in keeping that number down. Not that $20 billion up year over year is not big. Credit card balances brought in a total debt of $860 billion. Next is going to be auto loan balances. Those rose by $90 billion to $1.46 trillion. Now, these numbers then are going to be rounded out by HELOCs and other. So not sure exactly what other is, but there's some things lumped in there as well. So now that we know consumer debt is definitely on the major rise, let's take a look and see what that means when we're introducing record inflation into the picture. How are those two correlating? What's the kind of positives and negatives? Now, inflation has a direct effect on the purchasing power of consumers. Higher prices for goods and services as a direct result of inflation reduce what a dollar will buy today. Consequently, consumers may borrow more as a way to increase personal buying power for everyday needs, such as using a credit card to grocery shop, but that's all going to add to your personal debt, of course. Guys, high inflation simply is not going away. In fact, prices are going up at their fastest rate since the early 1980s. Prices in January rose 7.5% year over year, according to the most recent Consumer Price Index report. Now, this is going to be the biggest annualized growth in CPI inflation since February of 1982. You can do the math. That's been a long time. According to the Bureau of Labor Statistics, the high rate of inflation in January was driven by gains in food, electricity, shelter, and obviously all of these are going to be putting further pressure on the bottom lines of average Americans. How can it not? Energy prices grew yet again, with total prices jumping 0.9% from December, while the 12-month gains are still an astounding 27%. Next, we're going to take a look at gasoline prices. Those actually dropped 0.8% in the month, but they're still 40% higher year over year. Oil rose 9.5% in January alone. It'd be interesting to see what happens with the Ukraine situation, as they certainly could drive prices even higher. Guys, we're all tuned into that right now. We're certainly going to be dropping some videos on that as it's kind of continuing to unfold. Prices of used vehicles are up nearly 41% compared to 12 months prior. Food is 7.5% higher. Shelter costs have gone up by 4.5% during the same period. So obviously there's a theme here. Everything really pretty much across the board is going up. Now, controlling inflation is one of the main tasks of the Federal Reserve, in addition, of course, to maximizing employment. So the January inflation data serves as yet another reminder that the Fed has more than enough reasons to start raising interest rates and really start to tighten up monetary policy. Now, Fed officials certainly took their time acknowledging that renewed inflation growth would require sustained policy response. Over the recent months, though, they've certainly recognized that prices won't be transitory. That was kind of their favorite catchword for a while, or temporary, and could be a major threat to the labor market and the rest of the economy. Was so tired of hearing transitory. Obviously, that did not turn out to be the case. And on January 11th, Fed Chair Jerome Powell told the Senate Banking Committee, high inflation is a severe threat to the achievement of maximum employment. Again, the second prong to their duties is achieving maximum employment. And according to Larry Adam, who's the chief investment officer at Raymond James, I think the Fed will raise rates 3 to 4 times this year. By the end of the year, inflation growth could be on a clear downward path. And so the 5 to 7 hikes that people are talking about wouldn't be needed. Now, markets are expecting the Fed to start increasing rates in March, the first of what's said to be approximately 5 increases this year, totaling 1.25 percentage points. And these rates are directly tied to the prime rate that consumers pay for many forms of debt, including credit cards and adjustable rate mortgages. Don't see a lot of ARMs anymore, but there's still some out there. So let's take a look at high inflation with high consumer debt. What do those look like when they're both, kind of at those peak levels together? Now, the higher the inflation, the lower the value of the dollar. We've talked about that on inflation videos here previously. So as consumers are paying back their debt, they're actually paying it back with money that is worth less than what it was when they borrowed it. But they're still getting a dollar for dollar paid reduction in the principal. That being said, though, really high or hyperinflation and cost of goods can easily outpace increases in wages, which is exactly what's happening right now. During times of lower inflation, interest rates tend to be lower. The low levels of inflation can spur consumers to borrow for large purchases, such as a new automobile or a house. Debt obligations are lower over time because of the current increased purchasing power if interest rates on the loan remain steady, of course. So really the takeaway here is that inflation, depending on high or low, can really benefit the borrower or the lender in particular ways. Inflation allows borrowers to pay lenders back with money worth less than when it was originally borrowed, which obviously is going to benefit the borrower in that instance. Now, when inflation causes higher prices, the demand for credit increases, raising interest rates, which ultimately is going to benefit the lender there. But inflation can definitely help borrowers. If wages increase with inflation, and if the borrower already owed money before the inflation occurred, the inflation benefits the borrower. This is because the borrower still owes the same amount of money, but now they have more money in their paycheck to pay off the debt. In theory, of course. The result is less interest for the lender if the borrower uses the extra money to pay off their debt early. Now, when a business borrows money, it's different. The cash it receives now will be paid back with cash that it ultimately is going to earn as a business later. Kind of a basic rule of inflation is that it causes the value of a currency to decline over time. In other words, cash now is worth more than cash in the future. Thus, inflation lets debtors pay lenders back with money that is worth less than it was, of course, when they originally borrowed it. You're kind of seeing the theme there. Now, obviously, inflation can also help lenders, especially when it comes to extending new financing. So new customers, if you will. First, higher prices mean that more people want credit to buy big ticket items. On top of this, the higher prices of those items earn the lender more interest. Let's give an example of that. So if the going price for a refrigerator increases from $1,500 to $1,600 due to inflation, the lender makes more money because 10% interest on $1,600 is more than 10% interest on $1,500. Plus that extra $100 and all the extra interest might take more time to pay off, meaning ultimately more profit in the lender's pocket. So guys, as you can hear, there are a lot of moving parts here. What we try to do here on the channel is break down the information really ultimately to its simplest forms. Debt is a frequently necessary form of financing for many households. However, it does come with unique financial risks. When you're taking on debt, you've got the risk, of potentially losing a major source of income due to unemployment, for example. Well, even if you're unemployed, that interest is continuing to accrue and you're still responsible for those payments. These risks and costs of debt are unevenly distributed. And debt has increased in all forms during the pandemic, leaving many households in a financially precarious position. So really, kind of in my mind and maybe your mind as well, the question arises, Can debt be good during inflation? The answer is yes. Holding a lot of low interest fixed rate debt is actually a strong financial position to be in right now. That is assuming you can easily make the payments and additionally have extra money left over, every single month to invest. As long as inflation continues to run high, you shouldn't be paying off any extra debt. That would certainly be my advice. You should be investing that money so that you're increasing your buying power instead. And as this equates to your mortgage, the average home loan is currently well below 4%. Inflation over the past year was well over 6%. So if you take those rates, the effective real interest rate is actually negative. In other words, anyone with a reasonable mortgage has more buying power today because they carried the debt over the past year. Now, guys, everyone is in a different position, with good versus bad debt. And with the looming interest rate hikes, everyone really needs to assess their current situation, as well as be very intentional and deliberate moving forward when considering taking on new debt, and equally as important, paying off existing debt. We love bringing this information and data for you here on the channel, guys. As always, we're going to encourage you to go out there and do your own research. If you want more info like this, go ahead and smash that thumbs up button below. That helps out our algorithms, lets us know that we're on the right path bringing this content to you guys. Ring that bell below if you want the heads up alerts next time we bring additional videos here on the channel. Until next time, guys, thanks for joining us here on the VIP Ed YouTube channel, where we talk about all things credit, capital, and cash flow. Take care. See you next time.